Schiff, CEO and Chief Global Strategist at Euro Pacific Capital. Joe Besker and Howard Rosencrans also stay with me. Peter, I want to start off with you. Some people are less than optimistic about the market, but based on your notes, you are downright doomsday thinking that this market is fairly valued at closer to 12,000 than the current level of 17,000.
Well, you know, the market isn't going up for the right reasons. It's going up because we have a bad economy, not because we have, or because we have bad monetary policy, not because we have a good economy. And, you know, that said, I'm not short the market because I recognize that inflation causes prices to rise and stock prices are among them. But I am long other markets that are outperforming the U.S. as well as other asset classes. You know, the U.S. market outperformed global markets in 2013, but that's probably the last time that's going to happen for many, many years. So
you're going to have to clarify for me. You just told me you're not short the stock market, meaning you're not betting that the stock market's going to fall, but you're telling us that it's going to fall.
No, I'm not telling you it's going to fall. If the Fed did the right thing, if the Fed removed all the monetary props beneath the markets and the economy and let interest rates rise, the market would fall substantially. But I don't think the Fed is going to do that. I think the Fed is going to sacrifice the value of the dollar to save the stock market, to prop up the housing market so it can pretend that we have a legitimate recovery. But if money is losing value, I don't think U.S. stocks are going to be a great long-term hedge against inflation. I think you need to look abroad, and I think you need to look at other assets like gold.
All right, I've got a stock market bull, Joe Besker, that wants to challenge you, Peter.
Hey, Peter, how you doing? What is the right thing? What you said that if the Fed would do the right thing, what makes it that they have? What do you think they've done wrong? Given the kind of economic turmoil we had. And while I agree with you that there's great other markets, why are you so sure that the United States market is going to be, you said for the last time for a long time, the U.S. market's going to be a leader. I'm sure you didn't tell me last year. I'm sure you didn't tell me last year the U.S. market was going to be a leader.
Including creating.
I'm sorry?
No, the Fed has done everything wrong, including creating the 2008 financial crisis. The Fed blew up the real estate bubble. So the problem was created by the Fed, and now it's been compounded by the Fed. What the Fed needs to do is let interest rates rise substantially.
Why?
Interest rates are too low.
Why do they have to, why do they have to do that?
That is the problem. Because we're not saving enough, we're not investing enough, we're not producing enough, we're just borrowing, consuming, speculating. So, all of that is thanks to the Federal Reserve. But it is not improving the actual economy. Look beneath these contrived government numbers. The U.S. economy is weakening.
Peter, I'm in the camp that we're going to enter a corrective phase, so I'm a little more bearish than he is. I am certainly not in your camp. And I do agree with you. The Fed did get it totally wrong going into 2007, and the Fed got it wrong for a lot of years. However, since that bubble, you know what? They got it right. They did exactly what they needed to do to stabilize the economy and to create the beginning of a liftoff. My assertion that we're going to have a correction is because, yes, they do have to take a step back, but I don't see any earth-shattering damage, and had they not stepped in, we really would have been in trouble.
They didn't stabilize the economy. They prevented it from healing. What they did is inject it with more of the monetary heroin that was the source of the problem. What they did is they delayed the consequences. The real crisis is still in our future because of the Fed.
Okay, and that is a very good point to make, because if the average investor, or the institutional investor for that matter, has been just playing this market and riding this bull wave based on the Fed's easy money policy, whether you think, Peter, that they shouldn't have gotten to that level of involvement or that they should have in Howard's case, should you even care? If it's going to continue, should you continue to own the stock market no matter? Hold that. We've got Peter Schiff, Joe Besker, and Howard Rosencrans still with me. Gentlemen, is the #1 thing that you're watching earnings? Joe, I know that's the first thing you said on set this morning. I asked you about a handful of things, and you said it's all about earnings.
Well, I said versus the global stuff. I have an earnings. I want to address Peter because, and I think sometimes we get confused as to what's going on. Markets are made up of individual companies, and where I think Peter's got it dead wrong is that The Fed did what it had to do to reflate businesses. I have been in business for over 30 years. I have never seen balance sheets on small and mid-cap companies better than they are today. Go back to 2007, they were horrible. So he's wrong. Companies are in good financial shape. They're in good financial setting. So the markets, yeah, they go up.
No, they're
go
not.
down.
They are leveraged to the hilt thanks to the Fed. And if interest rates are never allowed to rise, you're going to see how bad a shape these businesses really are in. In fact, the Fed propped up businesses that should have failed, and they prevented the businesses that we needed to expand come into existence from flourishing. But Sandra, before the break, you asked if we should care whether this is real or not, if we should just ride the wave of liquidity.
Right.
Look, the phony recovery we had between the recession of 2001 and 2008, that was created by the Fed stimulus. And we know what a disaster it ended up with in 2008. The problem is we've doubled down on those same failed policies. We have an even more phony recovery than we have now than we had then. And so we have a bigger disaster looming. Only next time it might not be a stock market crash. I think it's going to be a dollar crash, which fundamentally is going to be much worse for the U.S. economy.
All right, Liz Mack, jump in.
This from S&P, and this is what's key. Companies in the United States took advantage of the Federal Reserve's cheap, low-rate policies. And what did they do? They borrowed a lot of money to basically lever up their balance sheet to do record number of stock buybacks. We saw that in the first quarter. Watch this. We have $4.5 trillion in cash held overseas by companies, the top 2,000 global corporate spenders that are U.S.-based. What we're seeing, too, is those same companies have, get this, $11.1 trillion in leverage in debt on the balance sheet. So that money that's parked overseas will go toward servicing that debt once interest rates starts to go up. That is why CapEx spending is so low in the United States. Companies are keeping it overseas in low tax havens to service that ballooning debt. So I happen to agree in some ways with Peter Schiff that the leverage is in there in the economy, but it's not really the Federal Reserve's fault. I hear about the low rate policies. It's really companies taking it. It's companies, hang on, companies taking advantage of it.
They're blowing all the air into this bubble.
Peter, hang on. It's companies taking advantage of it. You can't govern and dictate what companies are going to do.
Right. Peter Schiff.
Sandra.
Well, how are you going to blame them? It's like blaming kindergarten kids for destroying the classroom. When the teacher passed out all kinds of candy and soda pop and then left the room.
All right.
I mean, what do you expect? How do you expect Wall Street to act when they're all liquored up by the Fed?
I want to move this conversation forward because I feel like we're talking about where we are today in this equity market at record highs, Dow above 17,000, because of what's happened in the past. And it's everyone's responsibility, and I know a guy like you, Joe Bessiker, that manages money every day, to look to the future. And if we are talking about, everybody agrees we're seeing this unprecedented level of involvement from the Federal Reserve that can't last forever.
It's actually coming. It's actually getting less. And we manage money, but what we really do at Emerald is we make over 2,000 company visits a year. We're out there. I don't know how many companies Peter's seen. He makes these broad accusations about what the Fed is doing wrong and this and that. What I can tell you is that corporate America is doing pretty doggone well, and they're doing well because they're not kindergartners with candy. These are good, solid people that go to work and do good things, and they hire people, and they create great stuff for us to do. You have a great guy coming on here, a Cake Boss guy, who's created a great business. That's what these companies are.
They're the same accusations I was making right before the financial crisis of 2008. I made these accusations for years on these networks, and people ignored me, and we know how it ended.
The reality is it is a market of stocks, of individual companies.
Exactly.
The individual companies, and I don't know what your basis is for you talking about this incredible leverage. You were absolutely right. Going into the bubble burst, companies were over-leveraged. You know what? They got the message. And leverage ratios have come down very dramatically.
They got more debt. No one's got the message. And the government has a lot more debt now than it had in 2008. We're much more levered up. Why do you think the Fed has got interest rates at zero? Because we have so much debt. Zero is the most we can afford to pay.
All right, so Peter, I'm going to have you. Okay, let's bring this conversation back. Again, you said you're not shorting the market, but you say that the market should be valued at 12,000 rather than 17,000. So by saying
I don't
that
know where it should be valued. Maybe I think it should probably be below 12,000 if the Fed really did the right thing. But they're never going to do the right thing.
Peter?
So don't base your investment decisions on the Fed doing the right thing.
Are you buying the rally?
Yeah, I'm basing it on the Fed doing the wrong thing. I'm looking for value around the world. Fortunately, there are pockets of value. There are countries that aren't as reckless and irresponsible as we are, and there are better values in foreign markets. There's much better dividend yields out there, and you get appreciating currencies. The dollar, I believe, has a long way to decline. The Fed is going to print it into oblivion to try to keep these bubbles inflated, to keep the asset prices up nominally, to maintain the illusion of economic growth. So they're going to sacrifice the dollar.
Peter,
but if you're an investor, you don't want to sacrifice your currency.
Makes you look defensive. I'm looking at the U.S. dollar. It has had a string of consecutive gains. There is the future that is a possible rate hike. Goldman Sachs moved up their forecast for the first Federal Reserve rate hike this week. Sunday, actually, they did it. And now we are seeing the U.S. dollar strengthening against global currencies. You are constantly
Where is it strengthening? It's not strengthening against anything.
Can I say something?
Despite all this good news, the dollar hasn't strengthened. That's how weak it is.
All right, Joe.
Trucking in America is up for the 4th consecutive month. Freight haulers are doing well. Energy's doing well. Technology companies, we're not going to spend any less on cybersecurity. Peter, here's what I'm going to do for you. I've listened to you in 10, 11, 12, 13, and now here we are in 14. You've been calling, you've been ringing this bell. Eventually, you'll be right. I'll grant you that. But I'll take 5 names, any 5 names.
What do you mean eventually? I've been right.
Versus your gold, okay? And I'll take those 5 names. You can pick the time period, 6 months, a year, 5 years. And that gold, like Warren Buffett says, just sits there and looks at you. I want to invest in America. I want to invest in Americans.
Gold has outperformed the U.S. stock market so far since the year 2000
if you
by
can keep
a pretty
talking,
wide
just
margin.
let me finish,
so how about that time
Could you
period?
let me finish? Thank you. I will take those 5 names. All right, any 5, I'll put those 5 names versus your gold. You pick the time period. We'll do a bet for charity. I just heard your song time and time again, and you keep saying they're doing the wrong thing. Well, the results that I'm seeing for corporate America, they've been pretty doggone well. Period.
Yeah, what are your 5 names? And besides, I own a lot of stocks, too. It's not just gold.
Well, let's do your 5 stocks.
But chances are gold will outperform any 5 stocks you want to pick.
I can't let you go without asking. You just mentioned gold. I got a lot of tweets this morning when I said I was having you on. Is that the gold bug? All right, gold's at $13.22 an ounce, up $6 on the session today. Where's it going?
It's going a lot higher. You know, the only reason it fell in 2013 was because a lot of the latecomers to the rally at that time jumped to the wrong conclusion at the wrong time. People are optimistic about the U.S. economy. They think we have a real recovery. They think the Fed is going to take away QE and raise interest rates. They're wrong on all fronts. We are relapsing back into recession if we're not already there. And the Fed is going to jack up the amount of quantitative easing. Unfortunately, it's not going to eliminate it. And so gold is going to go ballistic.
I
don't know when this big rally is going to start, but I'm pretty sure that we've bottomed out. And so we've already turned the corner. The question is, when are we really going to accelerate
Peter's been wrong for so long, he's due to be right.
All right.
No, I haven't.
Peter, I gave you the last word, buddy. All right, Euro Pacific Capital CEO Peter Schiff, thank you. Emerald Asset Management Chairman and CEO Joe Bessiker, thank you. And Value Advisory founder Howard Rosencrantz, thank you for the lively conversation.